The Intelligent Investor is a fundamental book in the world of finance and investment. Written by Benjamin Graham, who is often called the father of value investing, the book offers a deep yet accessible guide for investing wisely and successfully. Lesson 1: Investing versus Speculation. Graham insists that investment must be an analytical and methodical operation. True investment involves three key elements: thorough analysis, the safety of the invested capital, and an adequate return. On the other hand, speculation is based on trying to predict and benefit from market fluctuations, which is inherently risky and does not guarantee the safety of capital. For Graham, a true investor does not get carried away by market predictions or passing fads. For example, investing in a company because it is believed that its shares will rise in the short term is speculating. Investing after analyzing its balance sheet, its market position, and its long-term prospects is investing. Lesson 2: The concept of margin of safety. The margin of safety is fundamental in investing. This concept involves buying an asset when its market price is significantly lower than its intrinsic value, calculated through fundamental analysis. This margin acts as a buffer against errors in analysis or unforeseen changes in the market. If a company has an intrinsic value of $100 per share, based on its assets, earnings, and prospects, but is sold in the market for $70, there is a 30% margin of safety. This not only increases the potential for gain, but also reduces the risk of loss. Lesson 3: Markets are emotional. Graham personifies the stock market as Mr. Market, who every day offers a different price for shares. Mr. Market is emotional, impulsive, and often irrational, reflecting the collective mood of investors. If Mr. Market feels pessimistic, he may offer to sell shares at very low prices, which can be a buying opportunity for the intelligent investor. If he is euphoric, he may offer to buy shares at very high prices, which could be a sign to sell. Lesson 4: The importance of fundamental analysis. Fundamental analysis involves a deep study of a company's finances, its business model, the quality of its management, its position in the industry, and its long-term prospects. This analysis helps determine the intrinsic value of the company. The analysis can include evaluating the price-earnings (PE) ratio, return on equity (ROE), debt, revenue, earnings, and other financial indicators. For example, a company with a solid track record of increasing revenue, little debt, and a good management team can be considered a good investment if its market price is reasonable relative to its intrinsic value. Lesson 5: Diversification. Diversification is the strategy of investing in a variety of assets to reduce risk. Not all investments will perform at the same time, so having a variety can protect against significant losses. Diversification can involve investing in different sectors, different types of assets, stocks, bonds, real estate, and in different geographical markets. However, Graham warns against over-diversification, which can dilute gains and complicate portfolio management. Lesson 6: Defensive investor versus enterprising investor. The defensive investor seeks safety and an adequate return with minimal effort. He prefers safer and less volatile investments, such as high-quality bonds and indexed funds. The enterprising investor, on the other hand, dedicates more time and energy to finding investment opportunities and is willing to take more risks to achieve higher returns. For a defensive investor, an indexed fund that replicates the performance of the market overall may be ideal. An enterprising investor might look for undervalued stocks, emerging companies with high growth potential, or make counter-cyclical investments. Lesson 7: Investing in growth. Growth companies, those with significant potential to increase their revenue and profits, can be good investments. However, it is crucial not to pay an excessive price for anticipated growth. A company in an emerging sector with innovative technology could be a growth company. The challenge is to assess how much of that future growth is already reflected in the stock price, and whether that price justifies the investment. Lesson 8: The psychology of the investor. Psychology plays a crucial role in investing. Fear and greed are two emotions that can lead investors to make irrational decisions, such as buying at the top of the market or selling at the bottom due to panic. During a market bubble, enthusiasm and greed can lead investors to ignore fundamentals and buy stocks at inflated prices. During a market collapse, fear can lead investors to sell at irrationally low prices. Maintaining a rational perspective and a focus on fundamental analysis helps avoid these mistakes. These lessons from The Intelligent Investor provide a solid foundation for prudent and thoughtful investing. Graham emphasizes the importance of patience, rigor in analysis, and a long-term perspective, principles that remain relevant to modern investors. If you want to reinforce these lessons, I recommend reading the complete book. You have the link to the book on Amazon in the video description. Subscribe to Start the Mindset, Change to Success.